Welcome back to the Deep Dive. Today we are digging into a really fascinating story, FactSet Research Systems, or FDS, and their Q1 fiscal 26 earnings.
And this one is a must-watch because, it's a classic market paradox. The company, operationally, had a great quarter. Solid beats all around.
But the stock reacted in the complete opposite way, a violent negative reaction.
Exactly. So our mission here is to really dissect that emotional sell-off and figure out where the hard financial facts just clashed with pure investor fear.
Okay, let's unpack that disconnect. You've got a company executing, but the stock gets hit hard. So where do we start? Let's ground ourselves in the actual results first.
Precisely. Let's start with the data. Revenue for the quarter came in at $607.6 million.
Which was a beat, right?
A measurable one, yeah. About 1.4% over what Wall Street expected, and that's up a pretty robust 6.9% year over year.
Okay, a clear revenue beat. How did that flow down to the bottom line to the earnings?
It translated well. Adjusted diluted EPS was strong at $4.51. That's another beat, about 2.7% over consensus, and shows 3.2% growth from last year.
And the really critical metric for a subscription business like this, their ASV.
Right, their organic annual subscription value. That's the key predictor of future revenue. It grew a really healthy 5.9% year over year. It's now sitting at about $2.39 billion. All of those are, undeniable signs of a healthy operation.
And here is where it gets really interesting. The results came out pre-market, and initially the stock opened higher. It was up over 2%.
So the market saw the good news at first.
It did. But then something shifted. By the end of the day, the stock had completely reversed and finished down a dramatic 7.68%.
Wow.
And the volume was huge. Trading was 2.6 times heavier than the day before. That kind of sharp reversal tells you the sentiment just flipped from, let's say, cautious optimism to outright fear.
That stock action just mandates a deep investigation, right? The strength was there, it was visible, but the market was clearly signaling that it sees some dark clouds on the horizon.
So before we get to the anxiety, let's just double down on that foundation. You mentioned ASV. The core subscription engine for FactSet it's everything to their valuation. How healthy are those customer relationships?
They're incredibly sticky. Client retention was strong at 91%. But even more telling is the ASV retention. So the dollar value they hold on to that was over 95%.
95%.
Think about what that means. Once FactSet is embedded inside a bank or an asset manager, they are incredibly difficult to rip out.
That retention is fantastic, but FactSet is a premium service. It's expensive. Are we sure this isn't just inertia? Firms are just too comfortable to switch. Are they actually winning new business?
That's a fair challenge, and they did address it, but just look at the user base first. It's approaching 240,000 users. And the growth isn't just flat. It's concentrated in their key segments, like wealth and asset managers, which were up 10% year over year.
Okay, so they're expanding seats. Where is this growth coming from geographically?
Regionally, the big star was Asia Pacific. It led the growth at 8% organically. Management said this is basically regional firms playing catch-up, modernizing their tech stacks, and choosing FactSet.
And the Americas?
The Americas grew a very steady 6%, mostly from their existing big clients in asset and wealth management.
And if we drill down into the type of firm, you said wealth drove 10% growth.
Mm-hmm.
But I want to pause on the segment they call deal makers. What does growth there signal about the broader health of Wall Street right now?
Deal makers is their banking and M&A crowd. That segment grew 6%, and management chalked that up to higher net seasonal hiring. So basically, M&A is recovering, banks are hiring again, and when they hire, they need more FactSet terminals.
So that 6% is kind of a leading indicator for optimism in the capital markets.
It is. And to your earlier point about competitive wins, they flagged two huge ones. They actually displaced an incumbent, and you have to assume that's Bloomberg or LSEG, at a global top 10 bank for their pricing and reference data.
That's a massive signal.
Yeah.
Pricing and reference data is like the absolute bedrock of a bank's operations.
It's the most mission-critical data there is. And on top of that, they won a deal with one of the world's largest investment managers to be their analytics book of record. So these wins show they aren't just holding on, they are actively taking share in the most valuable workflows.
So you have conviction from customers.
Yeah.
But the company is also signaling its own conviction, right? They're buying back a ton of stock.
A ton. They repurchased almost $140 million worth of shares in the quarter alone.
And the board backed them up.
In a big way. They upped the share repurchase authorization by another $600 million. That brings the total capacity to a staggering $1 billion. That's Management basically screaming that they think their stock is cheap.
Okay, so we've established undeniable health, accelerating ASV, big competitive wins, a huge buyback. This brings us right to the friction point, the reason the stock tanked. AI.
That's it. The strategic pivot and the investment it requires. The CEO laid out 3 priorities, and the market is just obsessing over the cost of the second 2.
Let's start with the first one, commercial excellence. They're changing sales incentives to push for new business and cross-selling. They said it's already leading to a faster sales cycle. That sounds like a good thing.
It is a good thing. But the anxiety is all about the cost of priority number 2, driving productivity through AI. And here's the thing, they shared some incredibly powerful results from their AI adoption already.
Like what?
Get this. Sequential growth and adoption across their AI offerings was over 45% in one quarter.
45% quarter over quarter. That's not an experiment. That is a full-blown transformation.
Yeah.
What are some of the actual results they talked about?
Well, they gave a great example. A new text-to-formula agent they've built now handles about 35% of daily formula support requests. And it resolves them in an average of 6 seconds.
6 seconds, compared to minutes for a human.
Exactly. For a busy portfolio manager, that's not just saving time, it's removing a huge point of friction. It embeds FactSet even deeper into their day.
And what about internally? Were they seeing gains there?
Exponential gains. They said their data operations team is now ingesting third-party data at 10 times the speed because of new AI models.
Okay, hold on. If they're 10 times more efficient, why is the market so worried about margins? Shouldn't these massive productivity gains just flow right to the bottom line?
And that is the absolute critical piece that the market is stumbling over. The efficiency gains are long-term wins. But the cost of building all this stuff is a short-term guaranteed expense.
Right.
Management was very clear. They're allocating about a third of their capital toward these structural investments, hiring AI engineers, modernizing their cloud infrastructure, cybersecurity.
And there was one sentence in the call that the market just seized on.
The one sentence. They explicitly said they expect Q2 operating margins to reflect a step up in investment. The market is panicking because the cost is immediate and guaranteed a margin hit next quarter, while the payoff from that 10x efficiency is just a promise for the future.
Investors are prioritizing the near-term profit ceiling over the long-term growth story. It's that classic conflict.
And it's exactly what high multiple growth investors hate. They're paying a premium today for tomorrow's efficiency, but getting hit by today's costs.
So how is FactSet defending itself against this narrative? I mean, they have pressure from the big legacy players, but also all these new AI startups.
Their defense really rests on 2 pillars.
Yeah.
Data quality and deep integration. Over 90% of their ASV comes from their own proprietary connected data, and they kept stressing their embedded workflows. Clients are running 8.4 billion with a FactSet query language requests every single day.
So the argument is, it's not just a data portal, it's a secure ecosystem that actually runs core business functions.
Exactly. They said the workstation is a secure channel for regulated financial workflows. This is vital. You can't just have some AI startup run a compliance report. It needs to be auditable, secure, with entitlements managed. FDS spent decades building that trust.
Okay, let's put it all together then. We have accelerating results, happy customers, incredible AI adoption, but a stock that sold off a cliff. Let's boil down the definitive reasons for the market's pessimism.
Okay, it was really 3 compounding factors. First, what I'd call guidance friction. They reaffirmed their full-year guidance, which is normally fine.
But he didn't raise it.
They didn't raise it. And the midpoints for both revenue and EPS actually landed just slightly below what the street was hoping for. That signals to the market that management sees less upside than the analysts had built into their models.
Okay, so that's number 1. What's 2?
Number 2 is the margin anxiety we just covered. That concrete warning about Q2 margin pressure just solidified the fear that this AI spending will structurally compress their margins for a while.
And the third piece is the bigger philosophical question.
The AI disruption overhang. Yeah. The big debate in the market is whether large language models will commoditize financial data, which would crush FDS's pricing power, or will FDS's curated data sets become even more valuable as the fuel for everyone else's AI?
And the sell-off tells you which way the market is leaning right now.
It's leaning toward the risk and compression narrative, for sure. And you have to remember the context. FDS was already weak, down about 38% for the year, while the S&P 500 was up over 14%. It was already a vulnerable stock.
But there was one fascinating comment during the Q&A that seems to push back directly on that disruption fear. Management was asked if AI efficiency would lead to clients cutting seats. cutting subscriptions.
And their answer was a hard no. They said they are not seeing real headcount reduction. In fact, in banking, they're seeing more hiring because of the M&A recovery.
So what are clients doing with the efficiency gains?
This is the crucial counter-narrative the market ignored. Clients aren't firing people. They're using the extra productivity to go after more market share. And that's driving increased usage of digital tools, including FDS's new AI products. It's an augmentation story, not a replacement story.
They're getting more embedded, not less. Okay, this is the perfect setup for our next segment. This is not financial advice. Time to pitch an outrageous but plausible trade idea to our hypothetical investment committee.
All right. The thesis here is pretty high conviction. The market has fundamentally overreacted to the short-term Q2 margin guidance. It's completely missing the scale of the ASV acceleration and the productivity engine that FDS is building.
Creating a temporary dislocation.
A significant one. This sell-off creates a short-term entry point based on what I think is, an ephemeral fear.
Okay, so what's the leveraged pitch? What's the play?
The play is to initiate a leveraged long position on FDS. Specifically, I'm thinking out-of-the-money call options that expire after the Q2 earnings release. The risk-reward here favors a really sharp snapback.
And the rationale for taking on that kind of risk, why bet on a Q2 surprise?
Rationale one is simple. The 7.68% drop is a backward-looking emotional reaction. It ignores the forward-looking data like the 45% sequential AI adoption. Rationale two is the kicker.
Go on.
The specific productivity gains they cited, the 35% automated support, the 10x data ingestion, it suggests that the Q2 margin hit might be way less severe than they're conservatively guiding for.
You're betting they're sandbagging.
I'm betting that the productivity offsets kick in sooner and faster than the street expects. If FDS surprises in Q2 by mitigating that margin pressure, or if ASV accelerates even more, this stock is going to reverse hard from this oversold level.
A high conviction trade betting on operational acceleration over immediate market fear.
That's the idea.
That wraps our deep dive. So we saw a quarter from FTS defined by really solid beats and incredibly successful AI adoption, but all of that was met with major investor skepticism about margins and future guidance.
And that leaves you with one final thought to mull over. If all this increased efficiency, like that 6-second formula agent and the 10x data ingestion, if that's not causing clients to cut seats, but is instead driving higher utilization of FDS's products, how long can the market really maintain its fear that FDS's curated data will be commoditized? When does it start to be viewed as the indispensable, irreplaceable AI fuel that the entire financial industry simply has to have?